Welcome to the Deep Dive. This Deep Dive, an episode of the Riffle, is brought to you by 10 Leaves. Today, we're jumping straight into the pretty complex world of financial regulation.
That's right. Specifically, we're looking at the Abu Dhabi Global Market, the ADGM.
Exactly. Their Financial Services Regulatory Authority, the FSRA, just published some important amendments. And our goal here is really to cut through all that dense legal text in their Prudential Investment Insurance Intermediation and Banking Rulebook.
Quite a mouthful. People usually just call it the PRU amendments.
Right, the PRU amendments. We want to give you the key takeaways, sort of a shortcut to understanding what these shifts mean for financial firms, and hopefully turn some complex rules into some, clearer insights for you. And right off the bat, looking at the source materials, something kind of jumps out. This timeline thing, not everything happens at once.
Oh, yeah, that's crucial. The staggered timeline. It's a big deal practically. Firms can't just update everything on one day. They're juggling two different deadlines.
Okay, so that means careful planning is needed, right?
Man. Absolutely. Meticulous planning, really. You need to know exactly which rule kicks in when.
Okay, so let's unpack that. The main documents we're looking at are things like the 19 August FSRA rules, PRU amendments rulebook, and the details on the changes themselves. The sources state the FSRA made and published these rules on August 19th, 2025. So what's the split? Which dates matter?
Good question. So August 19th, 2025, that's the publication date. And a lot of the amendments actually went live immediately upon publication, as the text says.
Okay, so immediate changes.
Right. Firms had to adapt to those straight away. But the really detailed changes concerning professional indemnity insurance, PII, those have a later start.
Ah, okay. When do those tick in?
January 1st, 2026. It gives firms a bit more breathing room, a few months to get that specific piece sorted.
Like a software update where some bits are instant and the bigger security patch comes later.
Exactly. That's a good way to think about it. Time to prepare for the more complex PII requirements.
All right, so let's tackle that PII update first then, the one starting January 1st, 2026. It's under Rule 6.12, and it targets specific firms, right?
Yes, specifically domestic firms in Category 3B, 3C, or 4.
And PII, just for clarity, is basically insurance against making mistakes, like negligence or errors in professional services.
Precisely. It's a safety net. If a firm's advice, or maybe lack of action, causes a client a financial loss, the PII is there to cover it, protects the firm and indirectly the client.
And the new rules here seem pretty robust. It's not just saying get some insurance.
No, definitely not. The key phrase is that firms must take out and maintain professional indemnity insurance cover appropriate to the nature, size, complexity, and risk profile of the authorized person's business.
Appropriate. That sounds like it requires some judgment, not just hitting a minimum number.
It does. It's about genuine suitability. And it goes beyond just the coverage amount. The insurer matters too. The policy has to be from an insurer or a regulated financial institution with a strong credit rating. Specifically, credit quality grade 3 or better from an external credit assessment institution, an ECAI.
Grade 3 or better. Why is that specific rating so important?
It's all about reliability. If a claim needs to be paid, you need confidence that the insurer is financially sound and can pay. It ensures the safety net is actually strong, not just, there on paper.
Right, makes sense. It's about the strength behind the promise.
Exactly.
Okay, so strong insurer, appropriate cover. What about the scope of the policy itself?
It needs to be quite comprehensive. It has to cover claims for work done right from the start, from the date on which the authorized person was authorized. No gaps allowed.
So no historical blind spot.
Correct. And it must include appropriate cover in respect of legal defense costs, because fighting claims is expensive, even if they're baseless. Plus, it needs to cover the conduct of not just the firm itself, but also its employees, its governing body members, and any agents acting on its behalf. It's a broad protection.
That really does sound like a wide net. And there are reporting rules, too.
Yes, ongoing obligations. Firms have to give the regulator a board-approved statement every year confirming their PII cover for the next 12 months. And they need to actively demonstrate that the cover is adequate. Plus, notify the FSRA about any material changes.
Like renewals or if it gets canceled.
Exactly. Or even if there's a significant PII claim made.
Yeah.
And the rules clarify that even a string of smaller claims adding up can count as significant.
So constant oversight is built in.
Pretty much. It's not a one-time check.
Right.
The FSRA wants to ensure the PII stays appropriate as the business changes.
And can big companies use one group policy?
They can, yes. The rules allow for a group-wide PII policy, provided it meets all the same conditions. So there's some practical flexibility there for larger groups.
Okay, so boiling all this down, what does this beefed up PII really mean for you, the person or company dealing with these ADGM firms?
Well, fundamentally, it means better indirect protection for you. The rules are pushing for high-quality insurance from financially solid providers. So, if something does go wrong due to the firm's error, the chances of the loss being covered by a reliable insurer are much higher. It shifts potential risk away from your assets.
So it enhances trust in the system.
Definitely. It's a key piece in making the ADGM financial ecosystem feel safer and more trustworthy for everyone involved.
Okay, good. Now let's switch gears to the changes that happened immediately back on August 19th. These relate to Chapter 3, Capital and Leverage.
Ah, yes. Capital requirements. Always fundamental for financial stability.
It's the bedrock, isn't it?
Absolutely.
Yeah.
This chapter sets out how much capital these firms' authorized persons need to hold. And it's closely linked to the international Basel Accord framework.
Basel, like Basel First, Tip 2, 3.
Exactly. Think of Basel's Pillar 1 that sets the basic minimum capital requirements based on risk. And Pillar 2 is about the regulator's own review, the SREP process we'll touch on later, where they can potentially add more capital requirements based on their assessment.
Got it. It's about having a financial cushion.
A cushion to absorb unexpected losses and stay afloat. That's the core idea.
Now, the ADGM uses categories for firms 3B, 3C, 4, etc., and these categories determine the specific rules, right?
Correct. The category dictates the capital requirements.
Can you give us a quick flavor of who's in which category?
Sure. Category 3B, for example, might be firms looking after public funds or acting as trustees. Category 3C is quite broad. Could be asset managers, fund managers, money service providers.
And you mentioned something new-ish earlier.
Ah, yes. Also in 3C now are firms issuing fiat-referenced tokens.
Right, the fiat reference tokens. What exactly are those again? Pegged cryptocurrencies.
Essentially, yes. Digital assets linked to a traditional currency, like a stablecoin tied to the dollar or dirham. They aim for stability, so they fall under financial services rules.
Okay. In Category 4?
That's typically things like arranging credit deals, giving investment advice, insurance intermediation, maybe operating certain platforms.
Understood. So let's talk base capital requirement BCR, the minimum firms need. Category 3C is generally $250,000.
Generally, yes, but it gets nuanced. If a 3C firm only manages certain types of collective investment funds, it can be lower.
How much lower?
Potentially $150,000 for public or retail funds, maybe even just $50,000 for other fund types, so it's tailored.
Okay, proportional, but then the token issuers.
Ah, yes. That's where it jumps significantly.
Mhm.
If a firm is authorized to issue a fiat-referenced token, the BCR skyrockets to $2 million.
Wow, $2 million. That's a huge difference.
It is, and it's a very clear signal from the regulator. They're treating this activity with a high degree of prudential caution. It reflects the perceived complexity, maybe systemic risk potential.
Basically saying, if you're in this game, you need serious capital backing.
Precisely. Serious activity requires serious capital.
What about Category 4 firms? The BCR is lower there.
Generally $50,000. But again, there's a key exception. If a Cat 4 firm operates a private financing platform and holds client assets, the BCR goes up to $150,000.
Okay, what's a private financing platform? Is that like crowdfunding or peer-to-peer lending?
Sort of in that vein, yeah. It's often a digital platform connecting investors directly with businesses needing funds, maybe for private equity or debt, outside the traditional banking system, alternative finance.
So again, the capital follows the specific activity and risk.
Exactly. Very tailored.
Now, beyond the BCR, there's another layer, the expenditure-based capital minimum, or EBCM.
Right. This is calculated based on the firm's annual audited expenditure, their AAE,
And the point is?
to ensure they have enough capital to cover operating costs, even if things go bad. It's a buffer for operational resilience based on how much it actually costs to run the business.
Like keeping the lights on and paying staff during a tough period.
That's the idea. A cushion based on running costs.
And the sources show the fraction of this annual expenditure they need to hold varies a lot.
Oh, hugely. It's highly calibrated to the activity.
Give us some examples.
Well, remember those Category 3C firms issuing fiat reference tokens? They need to hold capital equal to 1 full year of their annual audited expenditure.
A whole year's worth of expenses in capital.
Yep. But then you look at, say, a Category 4 firm that doesn't hold client assets or insurance money, and they might only need 650 seconds of their AAE.
So just over a month's worth.
Right. Big difference. Or firms holding virtual assets in custody need 200 and 650 seconds, half a year. It really depends on the risk profile. The core principle is clear. Higher perceived risk means a bigger operating cost buffer is required.
Okay. And then there's Rule 3.7a, the liquid assets requirement. This is an update, too.
Yes, a crucial one. Categories 3B, 3C, and 4 firms must now hold liquid assets that are more than their expenditure-based capital minimum requirement.
More than the EBCM. And what counts as liquid here? Cash under the mattress.
Well, cash in hand counts. But mostly it's things like deposits with well-rated banks. Banks with a short-term rating of 20 or better, or long-term of 3 or better.
So stable banks.
Right. Demand deposits, short-term time deposits, things readily available. What doesn't count is important too. Anything pledged as security or money held in client accounts. It has to be the firm's own unencumbered liquid funds.
Got it. Truly available cash or near cash. So putting these capital rules together, BCR, EBCM, liquid assets, what's the overall picture for firms in ADGM and for us interacting with them?
It shows a very deliberate approach. The requirements are proportional to risk and activity. The aim is financial resilience, making sure firms can weather storms without being excessively punitive on lower-risk businesses. For you as a client or investor, it means the firms you deal with are subject to rules designed to make them financially robust. It enhances the overall safety and stability of the market.
Okay, last major piece. Enhanced oversight through the Supervisory Review and Evaluation Process, or SREP. This also took effect immediately.
Correct. SREP is basically the regulator's ongoing checkup on how firms are managing their own risks.
And there are two key internal processes involved here, IRAP and ICAP.
That's right. It helps to understand the difference. IRAP, the internal risk assessment process, is broader. It's the firm's own holistic look at all its risks, operational, market, credit, you name it.
Okay, the big picture risk assessment.
Exactly. Then ICAP, the internal capital adequacy assessment process, is more specific. It's where the firm figures out if its capital is adequate for those risks identified in the IRA. They work together.
And the significant change here is?
The scope of IRA has been explicitly extended. Now, Category 3B and 3C firms must conduct this comprehensive internal risk assessment process.
So more firms are now required to do this deep internal risk dive.
Yes. Previously, it might have been more focused on the biggest players. While ICAP and the regulator's power to add extra capital requirements, the Pillar 2 aspect, still mainly targets the higher risk categories like 1, 2, 3A, 5.
Right.
This expansion of IRAP down to 3B and 3C means increased scrutiny across a wider part of the market. It's proactive, pushing more firms to really think about and document their risks.
So why should you, the listener, care about IRAP, FSRA, all this regulatory jargon?
Because at the end of the day, more scrutiny means more accountability for these firms. It forces them to be rigorous about understanding and managing risk, and that feeds into a safer, more transparent financial environment for everyone.
It also shows regulation isn't static, It adapts to new activities, new risks, trying to keep the market robust.
Okay, so as we wrap up this deep dive, we've covered quite a bit. Tailored rules from the ADGM. We saw the beefed-up PII requirements for stronger protection.
Focusing on insurer quality.
The really dynamic, risk-based capital rules ensuring firms are stable with those specific requirements for things like token issuance.
And this expanded supervisory oversight, demanding more internal risk assessment from more firms.
All contributing to resilience and trust.
It definitely paints a picture of a regulator fine-tuning the rules for a complex market.
It does, and it leads to a final thought, perhaps. If these changes show this move toward really granular, activity-specific, risk-based rules, what's next?
Meaning?
Well, what are the next emerging risks or financial innovations that aren't fully covered yet? What might trigger the next wave of adjustments from regulators, not just in ADGM, but globally? And how will that shape the financial world we all operate in?
That's definitely something to chew on. What comes after stablecoins and private platforms?
Exactly. What's the next frontier for regulation?
A great question to leave our listeners with. Thank you for joining us on this deep dive. This deep dive and episode of The Riffle was brought to you by 10 Leaves. Keep exploring, keep asking questions, and stay informed.